Thank you for joining us today on part 3 of our webinars. These are the condensed WSHFC Low-Income Housing Tax Credit Fundamentals webinar. If you are watching this webinar, which is part 3, we hope that you have watched and suggest that you watch before moving on part 1, which is our federal and state compliance, part 2, which is income, and then as well our resident certification forms. If you haven't watched those before this, we suggest that you do so that you know which forms we are referring to as we're going through these presentations. This training course that you're going to watch today is being presented as an interim to our fundamentals during the COVID crisis. These webinars that you are watching are not in lieu of any of our full-time compliance courses, and you will not receive a certificate for these. As soon as the courses open back up in person, we strongly suggest and urge you to come to those. Anything that you see today could be additional to any policies and procedures that you have set forth by your management companies or other programs such as HUD, RD, Home, or Housing Trust Fund. Please make sure and check with your owner or management company to make sure that you're following their policies as well as ours. And these policies that we are going over are policies and requirements from the IRS and from the Commission.
In this presentation, we're going to talk about assets, verifying assets, and calculating the income from the assets. In the tax credit program, households with a total combined asset amount of $5,000 or more must be verified. That is a total accumulation of all assets by household member. So if you have 5 members in the household, each member has $1,000 in their savings account, that would be $5,000 or more, and then it would trigger all assets to be verified. So in the tax credit program, if you have a combined household total asset of $5,000 or more, you must verify all assets. If the total combined household assets equals $5,000 or less than $5,000, you do not need to verify those assets, but the household must complete the under 5,000 asset certification or sworn statement of net household assets form. From here on out, we're going to call this the under 5,000 asset certification form. If they have less than $5,000, you will have them complete the under 5,000 asset certification form, but you will list all assets on the household eligibility certification. You just do not need to verify those assets. Assets have a market value and a cash value. The market value is the value of that asset on the open market. For example, if you have stocks and every day the stocks are going up and down, whatever that value of those stocks are at that time period is the market value. The cash value is the market value minus the cost to turn that asset into cash. So those stocks might equal a market value of $1,000, but to change those stocks into cash, there's going to be a fee involved. So you would need to take that market value of $1,000 minus that fee. In this case, let's use an example of $50. So $1,000 market value minus $50 to sell those. The cash value would then be $950. There is also an imputed income versus an actual income. If the assets are over $5,000 for the combined household, you must do 2 types of calculation. You need to calculate what the actual value or income value is earning on those assets, and you must impute an income off of those assets. The imputed amount that we use at this point is the passbook savings rate set by HUD. HUD currently has that rate set at 0.06%. Our household eligibility certification form currently has a set value of 2% calculation. You are completely allowed and okay to change that 2% to a 0.06%. If you keep that 2% on the household eligibility certification and calculate the imputed income off that, it could put the household over income. So it would be okay to calculate off the 0.06%. Please be aware that W-bars may have a set amount of 2%. Just make a note in the comment section if that is happening. Assets that are owned jointly may be prorated. So in many cases, we see situations where an elderly parent is a joint signer on one of their adult children. You need to find out who actually owns those assets. Is the adult child on there simply for security purposes, and your resident owns all of those assets, or do they share the two? So you do need to check and see whether they're owned solely by your resident or by two different people. Just having a name on the account does not mean the account is owned by that person. Joint accounts require more information: who receives any income from those assets and who pays the taxes on those assets. There are different types of financial accounts. There's checking, savings, money market, CDs, stock bonds, mutual funds, foreign financial institutions, cyber, such as PayPal, Venmo, etc. Remember that Social Security and TANF get paid onto a cash card. Those cash cards are considered asset accounts and may need to be verified if the total household assets equals $5,000 or more. When verifying these type of assets, we do have a bank verification form on our website. There are many financial institutions that require their own verification form. It is completely okay to utilize the bank-specific verification form. To verify these type of accounts, either utilize the verification of deposit form from our website or the bank-specific form, or you may utilize the most current 6 months worth of bank statements. I highly recommend that you attempt to use the verification forms. If you're unable to get those, then you need to get the most current 6 months bank statements. When utilizing bank statements, we want all pages of all 6 months worth of statements. The market value and the cash value for those accounts, we utilize 6-month average on the checking account. And then the income from the asset in the checking account would be the market value, or the balance in the 6-month balance, times the interest rate that they are receiving on their checking account. Many checking accounts do not have an interest rate, therefore you would use 0. On CD, money market, savings account, many stock, bonds, mutual funds, etc., you would utilize the current balance of that account if it's a savings account. The income is the market value times the interest rate, and that will give you the income from that asset. So checking accounts, we utilize a 6-month average. Savings account, we use the current balance. Many bank or financial institutions on the checking account will give a 2-month 3-month or a 12-month average instead of a 6-month average on the verification forms. We will accept the whatever month average that bank sends on the verification form. And Crystal will continue with the next section.
So then we're going to go over 401k, IRAs, and retirement accounts. These accounts are always considered an asset unless the household does not have access to the funds, the household is receiving periodic payments. Remember what periodic and sporadic mean. Lump sum awards like SSI back payments, severance pay, insurance settlements, etc., are valued as an asset. You need to make sure that you verify with appropriate verification forms and/or most current account statements. Whole life insurance policies. For these accounts, you'll use the cash surrender value amount. The income is equal to guaranteed interest rate or annual earnings. And remember that term life does not have a cash value. Annuities is the market value. The market value equals current value. Periodic distributions equal income. And if the balance of the account can be withdrawn, it's an asset. It's equal to an asset. Trust account. A trust account is a fiduciary relationship in which one person, the trustee, holds title to property or assets for the benefit of another person, the beneficiary. We see trust accounts often, so you have to figure out who the trustee is and who the beneficiary are. To determine the type of trust, you need to know first if it's revocable, meaning it can be changed, or if it's non-revocable, meaning it cannot be changed. In order to do this, you want to obtain a copy of the legal trust document, the full document, not just 1 or 2 pages, so make sure you have the whole thing. And you need to determine whether the household has access to the funds, either as income or as an asset, how it's set up, right? And then assets placed in a non-revocable trust may be a disposed of asset. So you need to read through the entire document and see what it comes up with. Trusts sometimes are a little different. So if you ever get hung up on one of these, I suggest that you read through it, find what you think is relevant or non-relevant, and come up with what you think should be counted or not counted. If you have questions, email that document over to your portfolio analyst and say, here's what I come up with. What do you think? And we can definitely take a look at it. So one thing that I just want to point out really quick is if you're sitting in your management office and somebody comes in and they apply for housing, and when they're sitting at the table with you completing their REA, they say, or even before that, they say, well, I don't have any income. However, I have $1 million in assets, and I live off of that $1 million. As long as they're not taking monthly payments from that $1 million, but instead just one lump sum per year, this is okay. If you take the $1 million in assets and you times it by 2%, which is the highest that you can use, correct? You come up with $20,000 per year in asset income. So just because somebody has $1 million in an asset does not mean they're overqualified for tax credit housing. Always make sure that you ask the leading questions about their assets to determine how much assets they really have as a cash value. Or another term that we use is liquid value. If you were to go to the bank and cash out your assets. What is the liquid total that you would walk out with? That's what we're concerned about. Now we're going to jump into real estate. Real estate owned is considered an asset. How to determine the real estate cash value? We have a great form on our website. Again, make sure that you're watching the forms webinar before this so that you know which forms we're talking about. You would determine the fair market value of your real estate, subtract out the mortgage principal balance, the cost to sell, and then this would come up with your asset cash value. Online valuation sites, real estate agent appraisers are going to help you to determine your fair market value. So you could use the tax assessor's website, something similar to that. Your most current mortgage statement is going to show you how much your mortgage principal balance is. And then on our form, it actually uses 10% as the cost to sell total. If you come up with a different total than that and it's documented, you can use that. We just use 10% because it's about a fair average of the percentage that is taken out. If a resident holds a real estate contract or mortgage for real property, a real estate contract holder is the individual or entity that owns the real estate loan. You need to obtain a copy of the loan contract and amortization schedule. The cash value and market value equal your principal of loan at certification effective date. And asset income is equal to the amount of interest paid over the next 12 months according to the amortization schedule. So it's very important that you gather all of that information. So if you have some real estate that was most recently sold, you're going to see a HUD 1 settlement statement or something similar that will look something like this. The amount of cash that went to this seller was $64,414.96. That was after their costs, their mortgage, and everything was all paid for. They pocketed $64,414.96. The reason why this is important to you is because you have to know where that $64,000 went. Was it used to pay off additional bills that they had? Was it given to somebody? Is it in their savings account? What happened to that money? So your questions that you need to ask would be, I see on this statement that you received about $64,000 from the sale of your home. Can you tell me what happened to that money? And if they say, yeah, well, I gave my nephew $60,000 out of that just as a present. That $60,000 is an asset disposed of for less than fair market value, and you need to count that for 2 years. And we'll go over that a little bit more in depth here in the next couple of slides. If they say that they paid off $60,000 worth of credit card debt that they had, you would have them do a self-affidavit showing what happened to that money.
And this leads us into assets disposed of for less than fair market value. If a resident has disposed of an asset or sold an asset that was significantly less than fair market value or given away into a trust, this may be considered disposed of for less than fair market value. And we need to count the market value for this item for 2 years after disposal. We see this a lot when parents are becoming elderly and they have real estate or some sort of valuable asset. Rather than selling the real estate on the open market, they like to pass it down to their children. So they may sell it to their children or give it away to their children. And this is a significant asset amount that is now no longer in their possession. So the cash value at the time of disposal must be determined, and you need to impute interest on this for 2 years after the date of disposal. And Do not count any type of assets that were lost due to a bankruptcy, a foreclosure, or a divorce. Personal property as an investment. Personal property as an investment is included as an asset. And we define this personal property such as jewelry collections, antiques, stamp collection, or a toy collection, or a coin collection, something that has value and something that they do as an investment. A lot of people invest in gold or silver. That would be considered an investment, and those type of assets would need to be counted. Things that are not included would be personal items that are used for everyday use, such as furniture. Business assets and equipment is not counted. Cell phones, vehicles, personal jewelry, and furniture. So those type of things are not included. The personal property as investments, you would need to obtain a current market value from an appraiser. So the resident would take those investment items to an appraiser, and the appraiser will write up an appraisal. And the cash value on these is, again, the market value minus the cost to sell and turn those items into cash. The next is cash on hand. Significant amounts of cash on hand must be disclosed. There are many people who do not like financial institutions, or they choose not to put their money into financial institutions, so they decide to stuff it somewhere around the house instead of putting it into a financial institution. So this type of cash on hand isn't necessarily what we're talking about. We are talking about this type of cash on hand, a significant amount. Remember that if the total household asset amount is greater than $5,000, it must be verified. So in this situation, to verify this type of amount, you would simply have the resident write out a statement that they have X amount of cash on hand, and you would have that notarized by a notary.
So in summary, assets sometimes seem a little bit difficult. However, as long as you get the correct documentation that you need, you should be able to calculate the income that is received from them. A lot of times, the majority of assets that we see are checking and savings accounts, occasional CDs, some trust, more real estate, but hardly ever do we see lots and lots of assets at properties. If you're ever in doubt of how to count it, or just need to have somebody double check your figures, definitely contact your portfolio analyst with the backup that you've received, and we should be able to help you. We hope that you're enjoying our webinars that we are posting for you. They should be posted frequently, and we should have a case study coming up soon, as well as income and rent limits. Right here is our compliance main page on the WSHFC.org website. As you can see here, we have forms and reports, income and rent limits, tax credit compliance manuals, and the tax credit compliance FAQs. If you are not part of our e-news monthly newsletter, we strongly suggest that you become part of that so that you can see anything that's new and upcoming in the housing finance in our world. Visit www.wshfc.org. And as a reminder, please make sure that you watch the prerequisite, which is our resident certification forms, as you can see here outlined in red. And this is a little bit older of a screenshot, but you will see up above under the compliance training videos, link to the 2020 compliance update There's also part 1, part 2, and now part 3. If you have any questions regarding post-year 15 procedures, please visit that website as well. And last but not least, we thank you so much for listening to us. And if you need to get a hold of your portfolio analyst, here are their first name and last names, their email addresses, and their phone numbers. We are all out of the office at this time working from remote locations, so if you leave a message, be sure that your phone will accept blocked calls to call in, because most of us are using our personal phones. We do block the phone number before calling you back. It's easiest and quickest to email us, and we will respond back to you. Thanks again. Have a great day and stay safe.